industry. According to them, the proposed rules currently open for stakeholder comments, and which is why we'll be discussing it this morning, could leave all 4 existing Tier 1 bank HOLDCos, GTCO, Access Holdings, First HOLDCo, and Stanbic IBTC Holdings. It could leave them below the new capital threshold. We know the banking sector just went through a recap, and it could create an estimated aggregate capital shortfall of about 370 billion naira. That's what they are saying. The investment firm notes that under the current framework introduced in 2014, HOLDCos are only required to maintain paid-in capital equivalent to the aggregate capital of their subsidiaries. However, the revised draft raises the threshold substantially by requiring HOLDCos to maintain capital that exceeds the combined paid-in capital of all subsidiaries by at least 20%. I will be having that conversation right now with Mr. Oji Udemezue. He's the Managing Consultant and Chief Executive Officer of Flame Academy and Consulting Limited, our go-to man for banking issues. Mr. Udemezue, good morning. Welcome to the program.
Good morning, Ini. Can you hear me?
Yes, I can hear you, Mr. Udemezue.
Okay.
Yeah.
Thanks for inviting me. So let's go on with the conversation on this very strategic and important policy in the banking sector in Nigeria.
Yeah, so please, first of all, help us to understand what all of this is about. We know that most of the Tier 1, the FUGAs, they're HOLDCos. And now we have this coming in and the possibility of them going below the required capital. Help us to understand this and why the CBN is even considering, this in the first place.
Okay, first of all, the HOLDCos are not below the capital requirement, required in the banking sector in Nigeria. Remember that CBN just moved the capital requirement for banks in different categories, that's commercial banking categories, from 10 billion for regional banking to 50 billion, and then from 25 billion to 200 billion for national license. And can you hear me? My network looks like...
Please, go ahead, Mr. Udemezue. I can hear you. Go ahead.
And then from 50 billion national license, international license, to now 500 billion. And the central bank had announced that apart from 1 or 2 banks, who are not even among the Tier 1, all banks in Nigeria have met this new capital requirement. So the HOLDCo regulation is a different ball game altogether. And the central bank, in their wisdom, in my view, is trying to be proactive to reposition the banking sector in Nigeria, to that point where, risks are separated among different entities. First and foremost, let me remind you that some time ago, Nigerian banks were owned by largely individuals who were known as the founders and who almost sat tight as the MDs of these banks until early 2000, when a new governance requirement came up that no MD will serve more than 2 tenures of 5 years each. And that became a concern to most bank promoters and founders and owners. But then the central bank, in their wisdom, had to implement that so that the very big names we used to know in the industry had to serve out their tenure and hand over to the next person and next person. So the idea of that is to ensure that banks are not under the full control of an individual person or family, such that decisions taken in lending and all of those things will center around one person. Just a corporate governance. Because banking business is very delicate and risky. A bank is given the license to collect money that belongs to several members of the economy. And when these monies are mismanaged, the bank will not just go down, but the people will lose their deposits, and the economy, most importantly, will suffer a big crisis. So, to de-risk the sector, central bank insisted that one individual will not run the bank forever, but these persons should serve their tenure and hand over. That brought about a new corporate governance system. And later on, they also found that, even though people left the system, they also control the system one way or the other. And then the new rule came in 2014 that, after the banking license was no more a universal license, where a bank will be doing insurance, asset management, stock market activities, pension, and so on. The license was now, how do I put it, divided into different activities. If you're running a commercial bank, better run commercial banking. If you want to do pension, insurance, asset management, do them separately. But if you so wish now, you can form a company known as a financial holding company who could just be an umbrella, covering a number of financial services activities that you have interest in, whether it's pension, insurance, mortgage business, other subsidiary activities that relate to financial, even fintech and so on. So that you can be a bank, and then be doing these things, but you can be a bank under a holding company and then now have other activities that go on, all also hiding under the holding company. That's the nature of the HOLDCo we have. And these HOLDCos, that's the holding companies, are not meant to be operational. They're not meant to run activities like banking or something. They are meant to be coordinators, providing board and governance, corporate philosophy and all of that, whereby the subsidiary institutions under them would not be the ones operating their various businesses, supervised by the board under the HOLDCo. But I think the central bank, in their wisdom, is also seeing a situation whereby even the individuals, we have said, run your own tenure and hand over, they stay at the HOLDCo and still almost operate these individual units of the HOLDCo. So this whole policy is about accountability, governance, and better management of risk in these entities. And as we go further, I will explain the implications of the rules in the ring fencing being promoted by this policy.
Yeah, because I think you should just go ahead, Mr. Odemisi, because there are fears that is going to, that's one of the things that I saw, that it's going to put them, it's going to need for the HOLDCos to go for a fresh round of capital sourcing. That's one of the fears.
Okay, now let me explain the capital part. From my understanding of this, by the way, it's an exposure draft, which they're still working on, and I believe that the central bank will still meet with the governors forum. I mean, the MDs forum, where the governor and the MDs of banks are always in constant communion and discussions. The thing about capital is that central bank is trying to say that if we must continue to have a HOLDCo system, then we demand that the HOLDCo will bring up more capital to protect the whole group from risks that may fly from different risky activities. Fintech, for example, and asset management may have different risk nature compared to banking, maybe retail banking or commercial banking. And if you're a HOLDCo holding businesses among all these sectors, even across borders, you have a HOLDCo that owns a bank, and that bank is in many cities in Africa. Nigerian banks are doing very well, actually, in the banking sector in Africa, sending investment across East Africa, West Africa, and even now Southern Africa is coming up. I think it's only in North Africa that we don't have so much activity. So as Nigerian banks are growing, they are putting their hands into various country risks, risks that are outside the country. And central bank is saying we need to protect our depositors and investors, so that risks that flow from these, other investments in different sectors and risky countries will not impact heavily on, depositors and investors in Nigeria. So what they're saying here is that when you combine your minimum capital in all of these entities you're holding, whether a pension business, insurance business, fintech business, with different risk profiles, when you sum the minimum capital requirement, including the banking franchise, by the way, when you sum the capital together, we now need you to have a capital in the HOLDCo that is not just equal or more than the total capital put together, but at least 20% higher than this capital. If a bank has a capital base of 500 billion, for example, insurance 50 billion, maybe asset management business 50 billion, in that HOLDCo, total capital is what? 600 billion. They are saying, please provide an extra 20%, that's 120 billion, making your total capital 720. This is more like, when you have a dam, you want to make a dam stronger so that when the water hits the dam, it will not easily overflow and cause the damages. So raise your dam a bit. That's actually the idea of economic capital, different from regulatory capital. But because CBN has seen that many banks are merely trying to, keep to regulatory capital, that's minimum capital requirement by regulators to enable you to run your business, the idea of economic capital is not being very much thought about by these banks. Economic capital says, despite the minimum regulatory requirement of capital in your business, you yourself should know the different businesses you do more than the central bank. You should be able to assess the risks you suffer in different sectors and different borders or countries, and be able to come up with an economic capital bigger than the regulatory capital that can shield you from risk. That's the idea of banks submitting what you call ICAP, Internal Capital Adequacy Assessment Procedure, whereby the banks speak to themselves and the truth about their risk and provide more capital than required by central bank. But what we have seen over here is that banks are merely struggling. Not all of them, though. Some have kept a decent margin above the minimum capital requirement, which is currently 15% for all the internationally active banks, and then for systemic important banks, that's domestic systemically important banks, what we call DSIB, they have 16%, 1% above the minimum capital of 15%. Now, banks are struggling to keep to that 16% if they are the FUGAs, or 15% for other banks, other IABs, internationally active banks. But central bank is saying you should go above that. So instead of allowing banks to come up with their own, personally assessed capital adequacy, they are now making it 20% above regulatory minimum. That's for the HOLDCo. But for individual limits, they can maintain their regulatory capital without any issues. So it requires banks, even though, we are talking about banks here because banks are the major components of this HOLDCo to start with.
Correct.
So you find that these banks have to now raise more capital to support the HOLDCo's capital holding to be above 20%, of the total capital added together.
All right, Mr. Demeze. So yes, we appreciate the fact that the CBN is trying to ensure, that these banks, whether HOLDCos or just the banks, that they have strong foundations that can withstand storms and protect customers' funds. But at the end of the day, we've seen the recap, and now we may be seeing another round of capital, being raised by the HOLDCos if, from your explanation. But the bottom line is, does this make the credits to consumers, credit to corporate, does it make it more available? How is it affecting the daily operations and businesses of Nigerians, not just, having the capital and getting the numbers and keeping the ledgers, but actually in economic activities? What impact can we say we have seen after the recap, or can we expect, even if this goes through for the HOLDCos?
Okay, thank you for that question. Allow me give a little more insight on this policy before I answer your question. One insight we need to understand is that HOLDCos are meant to hold the various units, the different units who operate their businesses and then report to the HOLDCo. But central bank is now saying that as we have the HOLDCo, the banks in these HOLDCos are also now acting as a HOLDCo of their own, investing in several banks in Africa. But they don't want that anymore. They want the Nigerian bank to report to the HOLDCo just as much as the Kenyan bank, the Ghana bank, the Rwandan bank, who are found in these different countries in the name of, let's say, Access or GT Bank or Zenith. These are banks expanding in Africa. So central bank is saying the Zenith Bank Nigeria, for example, or GT Bank Nigeria or UBA Nigeria should report to the HOLDCo just the way UBA or GT Bank or Access Ghana or Kenya and so on should also report to the HOLDCo. Otherwise, they should have an intermediate HOLDCo holding the bank, so that these banks will not be holding the same balance sheet, bundled together with all the subsidiaries, such that a risk in a particular jurisdiction can eat into the books of the Nigerian bank, affecting local investors and depositors. So they want to ring-fence the various members of this HOLDCo. HOLDCo is an umbrella, containing different businesses. So central bank wants these businesses to report on equal authority to the HOLDCo. But that's where you have the documentary problem. A place like Rwanda, for example, no bank or no entity can own a bank alone. Every bank in Rwanda is now a public limited liability company. It must be held by the public. So a Nigerian bank, for example, owning a bank in Rwanda must involve other owners. That's their own way of trying to de-risk banks from individual governance and not proper corporate governance. So according to your question now, when these things are eventually done, of course, CBN needs to give their support, documentary approval, and all of the support they need so that these banks can successfully, carry out these instructions in various jurisdictions. It's not going to be easy, but it can be done. In terms of the advantage to lending to the economy, the key thing here is that the more capital banks raise, just like we have seen, in the recent capital raising, the more the bank develop the appetite to give more loans because their risk capacity has just increased. But that's where also the concern is about risk. If you have increased your capital, for you to give good account of the capital to the owners of this capital, that is return on earnings, return on equity, return on investment, for it to improve or stay at the pre-capital raising level, you must compulsorily do higher business, make more profit and so on. And to do that, the primary business banks do to make money is lending. So we expect to see this activity or this regulation, dovetail into more lending by commercial banks, not just in Nigeria, but within Africa.
But also, Mr. Demezwe, considering the cost of funding, the interest rates, that's still a consideration.
The interest rate in Nigeria is a crazy one because there are several regulations around lending that force lending rates in Nigeria to be crazy. Like, when a Nigerian bank collects 100 billion for a customer, you have to keep 45 billion in central bank in CRR, cash reserve requirement. You can't do business with that. And you also have to keep another 30% in liquidity ratio requirement. So these funds are sterilized. And in economics, the loanable fund theory, the amount of fund from a deposit you can actually loan with in Nigeria is barely 25%, even though some of us know there are other ways that banks are allowed by central bank to improve their loan to deposit ratio. But as it is, when you look at the cost of CRR and cost of LRR, banks are struggling to lend even at below 40%. In Rwanda, where I am currently, I'm actually running a training for a bank in Rwanda. The current lending rate in Rwanda is about 15–16%. In Kenya, it's also around 14–15%. These rates are close to single digit, as you would desire in Nigeria. But far from it, because in Rwanda, the CRR is 5%, is 20%, which is actually not emphasized that much. So 5% sterilization is enough for you to lend at a low rate. But when central bank sterilizes your deposit at 45% CRR and 30% LRR, you only struggle to break even and maintain your cost of operation. So the policy of government in managing inflation has to reflect this. And meanwhile, while we tighten monetary policy by increasing CRR, inflation is not responding, showing you that our inflation is not demand pull, but cost push. So we have to look at medium to long term, how we can produce our own goods, import less of petroleum and other products to ultimately deal with inflation. Our horrible, or how would I say, very aggressive fight against inflation using demand pull measures is costing us bad economy, because as you increase these rates, borrowers borrow at a very exorbitant rate, making them non-competitive among China and other producers. And that's a big problem. When monetary policy is trying to tighten control inflation, it's causing business damage because manufacturers and factories borrow at a high rate, combined with poor energy supply, high cost of doing business, and so on, making our economy less competitive and making it almost impossible to achieve our double-digit growth in our GDP. These issues are complicated, but we hope that central bank, in their wisdom, will manage and coordinate these policies so that we don't have only a good lending rate, increased lending, but in the appropriate manner and terms and conditions.
All right, thank you so much, Mr. Oji Demezwe, Managing Consultant and Chief Executive Officer of Flame Academy and Consulting Limited. Thank you for your time and sharing your perspective.
We haven't done enough on this topic, but maybe next time we engage again. Thank you for inviting me.
Thank you.
All the best.
All right, now let's take a break. When we come back, the Pearl Awards Nigeria Corporate Summit celebrate 30 years and also discuss the reforms. Who's not discussing the reforms now? We'll have an elaborate conversation on that after the break. Please stay with us.